Warren Buffett, one of the most successful investors in history, has repeatedly warned about it. Buffett has often said, "The biggest risk is not knowing what you're doing." In 2026, this statement is more urgent than ever. Market volatility, inflation pressures, rising interest rates, and geopolitical instability are creating a perfect storm that exposes a subtle but deadly mistake. This is not about bad luck. It's about a structural error in how wealthy individuals handle their capital and make decisions. A mistake so common that even those with seven-figure portfolios are vulnerable. Today, we're going to dissect this problem step by step. We'll look at why it happens, how it manifests in real life, and why the usual solutions fail. By the end, you'll understand exactly what even millionaires get wrong and what you can do differently. The core problem. The number one mistake: overconfidence in apparent wealth while underestimating risk exposure. It's the illusion that having a large account balance automatically protects you from losses. Wealth creates a sense of security. It whispers, "You've made it, nothing can hurt you." And that whisper is dangerous. Consider an analogy. Imagine your fortune as a sleek, high-performance car. It's fast, polished, and admired by everyone on the road. But if you drive without brakes or ignore the road conditions, one wrong turn can send the car into a ravine. That's the invisible risk millionaire space. The bigger the car, the more catastrophic the crash if they miscalculate. The psychological roots are fascinating. Behavioral economists Daniel Kahneman and Amos Tversky found that humans consistently overestimate their competence and underestimate uncertainty. Millionaires are no exception. The more they accumulate, the more their confidence grows, not necessarily their understanding of the risks around them. This is called the overconfidence bias. It feels rational until it isn't. How this mistake manifests, let's break it down into concrete examples. 1. Portfolio concentration. Many wealthy individuals hold significant portions of their net worth in assets they personally understand or feel loyal to. A tech entrepreneur may keep 60% of their wealth in the company they founded. A real estate investor may tie up most funds in properties in one city. On paper, these assets are valuable, but in 2026, volatility is extreme. A concentrated portfolio amplifies risk, not protection. When markets swing, the fall is steep. 2. Liquidity illusion. Wealth can appear more liquid than it really is. Owning $5 million in real estate or private equity doesn't mean you can access it instantly. Buffett himself warns about overestimating liquidity. Cash is king, but don't confuse appearances with availability. In emergencies, economic downturns, sudden healthcare costs, or market crashes, the inability to convert assets into usable capital can be disastrous. 3. Debt leverage. Millionaires often use borrowed capital to accelerate returns. This is effective in stable markets, but leverage magnifies mistakes. If the market shifts suddenly, debt obligations compound losses. Even small miscalculations can wipe out years of growth. In 2026, interest rates and inflation create hidden pressures many fail to anticipate. 4. Ignoring behavioral traps. Emotions are an underestimated force in finance. Fear and greed are universal, but they intensify when stakes are high. Millionaires face unique pressures, social expectations, lifestyle commitments, and the fear of losing prestige. These pressures lead to impulsive decisions, selling low, chasing trends, or holding on to bad investments too long. Vivid example, take the 2008 financial crisis. Many wealthy investors seemed untouchable. Hedge funds, real estate moguls, and corporate executives with seven-figure portfolios suddenly faced margin calls, massive devaluations, and bankruptcy. Why? They assumed that prior success insulated them. They ignored correlations between assets and over-leveraged their positions. The crash was a harsh reminder that size of wealth does not equal immunity to risk. In 2026, the environment echoes that scenario in subtle ways. Inflation has eroded purchasing power globally. Energy prices fluctuate with geopolitical tensions, and central banks are unpredictable. Millionaires who fail to adapt are essentially navigating a minefield blindfolded, trusting that the size of their portfolio alone offers protection. The frustration and trap. The trap is psychological as well as financial. You can do everything right, save, invest, diversify, and still fall victim if you underestimate exposure or overestimate control. Wealth is seductive. It reinforces the illusion of invulnerability. This mistake compounds because it is invisible. Most errors don't feel like mistakes until the consequences hit. Imagine climbing a mountain while standing on a glacier. Your steps feel solid, your view is commanding, but the ice is cracking beneath you. Every wealthy individual is walking on their own glacier. Some glaciers are thicker, some thinner, but none are immune to hidden fractures. Buffett's genius has always been identifying cracks others ignore. His advice is not just about stock picks, it's about seeing risk where others see fortune. At this point, you should have a clear sense of what the number one mistake is overconfidence in apparent wealth while underestimating exposure to real-world risks. We've explored the psychological, structural, and practical sides of this problem, and the stakes are high. Most wealthy individuals attempt to solve this mistake with simple tactics: diversify, save more, or invest in safe assets. But these are often applied superficially. 1. Superficial diversification. Holding a mix of stocks, bonds, and real estate doesn't guarantee protection if those assets are correlated. During the 2020 pandemic crash, global markets fell almost simultaneously, exposing portfolios that were diversified on paper but concentrated in risk factors like liquidity or sector exposure. Buffett often warns, diversification is protection against ignorance. It makes little sense if you know what you're doing. Diversification without understanding underlying risk is a trap. 2. Blind reliance on advisors. Wealthy individuals frequently rely on experts or wealth managers, assuming their expertise removes risk. In reality, advisors operate within constraints and incentives that may not align with your risk profile. Many millionaires learned the hard way in 2008 and 2020 that professional guidance does not equate to immunity. 3. Ignoring macro shifts. Holding onto strategies that worked for years can be fatal. Economic regimes change, interest rates rise, inflation spikes, geopolitical tensions affect energy and supply chains. Historical evidence shows that repeating past patterns without adjusting for current context exposes you to hidden vulnerabilities. Historical perspective. Consider Warren Buffett's own behavior. During the 2000 dot-com bubble, he largely avoided tech stocks, not because he disliked technology, but because the risk was hidden and speculative. In contrast, many millionaires poured money into companies with soaring valuations, assuming past growth guaranteed future returns. The collapse taught an enduring lesson. Wealth can vanish quickly when exposure outpaces understanding. Behavioral science confirms this. Studies in cognitive biases show that people overestimate their predictive abilities and underweight low-probability catastrophic events. This is why even millionaires assume their fortune is safe. They're victims of optimism bias and illusion of control thinking that prior success shields them from future shock. Concrete numbers and examples. A portfolio worth $10 million in 2019, heavily concentrated in a single sector, could have lost 40% in the 2020 pandemic market crash, a $4 million decline. Those who diversified superficially with multiple ETFs in the same correlated sectors still lost 20 to 25% on average. Millionaires using leverage borrowing against assets could have seen 50% losses if forced to liquidate during market stress. These figures illustrate a simple principle: size of wealth does not equal safety. Protection requires structural awareness, liquidity planning, and behavioral discipline. Actionable steps to avoid this mistake. Here is a step-by-step framework to mitigate this hidden risk. 1. Assess true exposure. Go beyond balance sheets. Map how your wealth is connected across sectors, assets, and leverage. Identify hidden correlations. If multiple holdings respond similarly to economic shocks, treat them as one risk. 2. Stress test your portfolio. Use historical and hypothetical scenarios. What happens if interest rates rise 2 to 3%? If inflation spikes 5%? If a key market collapses 30%? Visualize outcomes as ranges, not single-point predictions. 3. Prioritize liquidity. Keep a portion of assets readily accessible in cash or cash equivalents. Even 10–15% of net worth in liquid, low-risk instruments can prevent forced sales during downturns. 4. Limit leverage and margin use. Leverage magnifies gains and losses. Only use debt if stress tests show you can withstand worst-case scenarios without selling core holdings. Buffett calls this the margin of safety principle. Preserve capital before chasing higher returns. 5. Behavioral discipline. Recognize your emotional biases. Millionaires often hold on to pride investments or chase trends to maintain status. Implement rules, predefine selling points, rebalancing schedules, and allocation limits. Automate where possible to avoid impulsive decisions. 6. Continuous learning and context awareness. Monitor macro trends and economic indicators. Stay alert to policy changes, inflation shifts, or geopolitical risks. Historical patterns can guide, but context matters. Adapt strategies rather than relying solely on past performance. Illustrative analogy. Think of wealth like a spacecraft navigating deep space. Success is not about speed or shiny engines. It's about shielding against cosmic hazards. Overconfidence is like ignoring radiation levels while hurtling forward. Even with a powerful vessel, one overlooked asteroid or radiation burst can cause catastrophic failure. The millionaires who succeed long-term are those who anticipate invisible hazards, maintain shields, and course correct continuously. Closing. closing, reflection. The lesson from Warren Buffett and behavioral science is clear. The largest, most insidious mistake even millionaires make is trusting that wealth alone guarantees safety. In 2026, the stakes are higher. Market volatility, inflation, and global uncertainty expose anyone relying solely on past success or apparent security. Your advantage is awareness, understanding true exposure, maintaining liquidity, limiting leverage, and applying behavioral discipline transforms your wealth from fragile to resilient. This is not theoretical, it's a system that allows you to act before crises strike. Ask yourself, am I treating my wealth like a high-performance vehicle without brakes, or like a spacecraft with shields, navigation, and contingency planning? How prepared am I for the invisible risks around me? Avoiding this single mistake may be the difference between preserving your fortune and watching it erode. Even if your net worth surpasses $1 million, Buffett didn't just build wealth, he avoided the traps that destroy it. In 2026, the same principles are more vital than ever.